Okay, guys, welcome to our FOMC news breakdown. So today's Wednesday, 17th of March, 5:22 UK time GMT. So looking at what we have this week, we've had an interesting week so far. Okay, and I will break down both sides, fundamental and technical. But the focus here really is for today. But let me just pull up this week. So I'm using fxstreet.com. Now, if you don't use FX Street, you're not familiar with it, there's others. There's dailyfx.com, which is a really good one. ForexFactory.com. I think my FX book also has um, its own. So this week we've had an interesting start to the week. Okay. And as we're going to see in a moment, the market, in the academy, all of the senior coaches, none of us have participated in any of the market movements really at all between Monday and Tuesday. Now, the reason for that is because of what we have today. So, yes, especially when it comes to the Forex market, trading is highly technical compared to, other counterparts, which are a lot more fundamental in nature. With Forex, because of the nature of the market, how the market is operated and etc., it you can use technical analysis to understand fundamentals before fundamentals come out, if that makes sense. Now, there are some issues, okay, or not issues to say, I don't want to call them issues, but some situations that arise, which is a better term, that occur, when we look at the market from a fundamental point of view. So I'd say with Forex, especially currency trading, I would say there's an 80-20 split between technical and fundamental analysis. So if we pull up what we have going along on the technical side later on, I think it will make a lot more sense when we have a look at this fundamental side. So on the fundamental side, getting straight to it. All right, in about 36 minutes, we're going to have three pieces, excuse me, of high impact news. Okay, we started the day with relatively moderate news to low impact news. And then coming into the afternoon US session for 12, we've had some more US news. But this is really the most important part of the news that we need to look at now. We have the economic projections report, which is very highly important, especially in what we have right now with COVID-19. Okay, we have a very uh, interesting type of world economy at the moment. There's many different dynamics and things that need to be considered. All right, and now if you don't know, okay, the US dollar, I'm sure you hear me say this many times over, okay, across many different channels and videos, that the US dollar, because of the position it has in the US in the world economy as the world reserve standard currency, what is very important to know is what I call the follow the leader kind of situation, which is if the Federal Reserve change their interest rates, if they make any modifications to their system of economy, okay, if there's any new policies put in place, okay, monetary policy put in place, hence why the monetary statement policy statement is a highly important piece of news. Okay, the world will follow, the rest of the banks of the world, central banks of the world will follow. Okay, we've seen in the 2008 crisis when the Federal Reserve took the charge to lower their interest rates massively. Okay, all the other central banks around the world followed suit. Okay, and so this is the picture we have in the economy we have, and there's many different reasons for it, which are beyond the scope of this video. But just always remember that the Federal Reserve is kind of like the leader that every other financial institution or banking institution or infrastructure of an economy follows. So according to the consensus, if we start with the interest rate, it's supposed to be staying the same at 0.25% or 25 base points. And what we had previously in the last rate decision was the same. Now, I do expect this to continue. Okay, it's very rare that the consensus um, is different from the actual results that come out. Usually, with central banks, one good thing is that it's very easy to read when they kind of put it in other words, or kind of, I wouldn't say it's completely blunt, but it is clear if you understand um, how to read, you know, the literature and speeches of the people in power in the Federal Reserve, what they say and what they write. If you find out what they're saying, you can have a good idea. So the consensus is still 0.25%, okay, or what we call institutionally the whisper number. All right, and it should be the same. And I guess, if we talk about it, the world is still in an uneven place. When we looked at the interest rate decision and also the accompanying rate statement from the Canadian dollar last week, we see that they've kept their interest rates the same also. Okay, even though they're recovering, they're more of an economy that's recovering more than others, but there's still an unevenness across the world. And so I think the Federal Reserve, for that reason, probably for COVID reasons, and wanting the economy to have a chance to reboot itself, as they, put artificial measures in place like stimulus packages or working with the government, quantitative easing, things like that to kind of, revive the economy. I think keeping interest rates low would be the wisest thing to do. Okay. Now at 6:30, 30 minutes after, we have the FOMC press conference. Okay. So after the rate statement is, released, the markets react. 30 minutes after, we have the speech. Now, for me, I find the speech even more important than the statement. Okay, because you can actually get to read, who is speaking, how, their face features. To me, I try to do, you know, my due diligence to look at their features when they're talking, what they say, how they look when they say it, because it is important, because you want to read between the lines. Because let's be honest, okay, when they are speaking, of course, they are under oath to speak the truth, but then the truth can be very highly manipulated, in a way. And so you want to make sure you get down to the truth. So I would advise, you know, especially students, okay, we have the infrastructure in place for you guys to be able to learn how to break down speeches. But speeches are important and they have the ability to move the market. Many times, sometimes nothing really happens with the initial data news, okay? But what we have then after is the speech news. Now, this is an interesting piece of news as well because we have two dynamics. We have data news and then we also have spoken or live speech news at the same time, okay? And so the data news may move the market in one way and the speech news can completely, totally reverse the market the other way. And sometimes there's a manipulative play involved where the market is used in that way to do such a thing, or the price moves in that way using the news, I should say. And so it'll be interesting to see what we have going along for in the next, in just over 30 minutes. Now, interesting enough, and I want to add this before I, switch over to what we want to look at for today in terms of the monetary policy for the Federal Reserve and things like that. At 9:45, we do have the GDP of the New Zealand dollar, which is high impact news also. And then we have the year on year for Q4, and we also have the quarter. Okay, both very important news pieces. Okay, the quarterly news has got 14% dropping down to 0.1% as the consensus. And then we have 0.4% previous and 0.5% for the next, for the expected for the next release at 9:45. And so we have an interesting dynamic here, and the numbers, how they go about, would be very important. So I think, one strategy that you can take off the bat is if you're looking at news, okay, there's great opportunity and of course great risk. So if you have, two currencies that are paired together, and the New Zealand dollar and the US dollar is paired together, the Kiwi, if they're paired together, okay, and then you have high impact news running, for these from basically 6 o'clock until 9:45, there is going to be a high chance that there's going to be a lot of movement, and which is great opportunity, okay, because there'll be high volatility, which equals to high opportunity. So we want to, take advantage. I'll do an analysis of Nzd USD from different aspects and see what we can find and what possibly we can get, moving forward, if there's any opportunity or what we could have going forward. So let's head over now. Let's have a look at the Federal Reserve. So I've got it up here already for you guys prepared. All right. And so for those of you, looking into fundamental news and you want to understand what all this stuff about fundamentals is about, and if you're a trader and you already know, then no problem. It will be a refresher. If you didn't know this, then great as well. So whenever we're looking at monetary policy reports, it's important to understand the gravity of them. Now, monetary policy reports, okay, they come out semi-annually, okay? So every 6 months. All right, so there's two a year. We have a testimony and we have a report. So we had one in February and the market did really respond to it last year. And we had one in June also. So this one is a very interesting one because we had pre-corona in or pre, I would say the deep onset of corona in the world, pre-corona, and then we had kind of middle of corona situation, or when some of the countries were kind of opening up again. So this is a very important report to read, and I will go through this in another breakdown. But what we want to do for now is just simply get straight to the point. And so February 19th, 2021, okay, so just 2 days shy of, or roughly about 2 days shy of a month ago, okay, we had the testimony and the report. Okay. And so the reason for this is because under the Federal Reserve Act, it requires the Federal Reserve Board to submit written reports to Congress containing discussions of the conduct of monetary policy and economic developments and prospects for the future. Okay. And this is called the Monetary Policy Report, and is submitted semi-annually, as you can see, so every 6 months, to the Senate Committee on Banking, Housing, and Urban Affairs, and to the House of Committee on Financial Services, along with testimony from the Federal Reserve Board chair. So in this case, it'll be Jerome Powell. So if you've ever seen the news, if you saw it last month, and if you never understood why, there's these two days, usually Tuesday and Wednesday. Sometimes it's different days, but roughly Tuesday and Wednesday, you'll see that there's this high impact news around about 3 o'clock where it says Federal Powell testifies. Okay, and the is a very nice way or lawful way of saying that he just gives a very concise but then detailed report onto the affairs of what the Federal Reserve is doing, okay, to the government, all right, of the United States. So if we look at what we have here, okay, in this report, it'll help us to have a good picture as to what we should be seeing going forward, because we're not going to have the next one until either it'll be June or it'll be July, okay, depending on when it happened. I'm guessing this one's probably going to be in July, possibly, but we'll see. Okay, either June or July. So if we look at the testimonial here, let's go and click on the testimony. So if you look at the testimony here, so it's not so long, as you can see. If I scroll down, I mean, for talking about the affairs for about 6 months, this isn't really a lot to say, but as I said, it's very concise but yet detailed. Okay, so you can actually watch now I think the Federal Reserve have a YouTube channel that they do have a YouTube channel, and you can actually watch Jerome Powell's live. I mean, it's already happened already, so I don't think you watch the playback, of course. So let's have a look at this. So when we're looking at the Canadian dollar, I was discussing about the US and how the Bank of Canada was discussing, the current situation of the US economy and what they're trying to do with, increased growth and consumption, and with their stimulus, that there's going to be an increase of, consumption. So quantitative easing, in other words, the stimulus is allowing for more money to be in the economy to then be used for more, consuming. And we know the US dollar from our studies is a consumer currency. So now we're looking directly at this. The path of the economy, if you look at this, continues to depend significantly on the course of the virus. All right. And this is, I think, the one line statement that's very important for now. Okay. Right now, the COVID-19 situation is not the only fundamental in the world, but it is a very interesting one because it's an overarching fundamental across every country. No country is exempt. Okay. Even the smallest country from the coronavirus. I think it actually has reached every part of the world. Okay. Even if it just has 2 cases, there are implications for even having one person having the virus, or if they have, as has been seen recently, having a variation of that virus or a different strain. And so this important line here is something to remember, and we can use this as a very good pointer to work out, okay, when do we think interest rates are going to be increased and what should happen? Now interest rates being increased is not the only factor that will affect the strength of a currency. There's many other things, at least 4 other things that are important. Okay, but one of the 2 things out of the 5 we're seeing is that we're seeing this quantitative easing. And as I've said, 2020 is very special in the sense that it is a financial crash that we've had, but the reason for the financial crash is different. And number 2, the recovery of the financial crash is what's very important as to why this situation is different. Because as I said earlier on, 2008, when we had the financial crash, when we had the quantitative easing measures in place and the financial stimulus, it was only for the private sector. It was only for the, the big banks and the big companies to be bailed out. So cash was given to them in an internal system that they have. Okay. And so there wasn't much inflation going out into the, or there wasn't much inflation, for example, in the dollar in 2008 going forward, as you would see now. And because the money was internal, it was, for the purpose of keeping the companies going, it wasn't given to the public. So there wasn't a broad dispersal of, cash into the US economy, and then of course into the global economy. All right. So there was of course quantitative easing, and of course any printing of money is going to cause the currency to devalue. Okay. But what we see here is that in 2020, because of the nature of what's happening, people have literally cannot go to work. Everybody basically has to be bailed out somehow. So this is a massive increase in the amount of money being printed or created, and digitalized and given as stimulus. So this is where, there's a very big difference. And therefore, looking at this right now, COVID is going to really be a strong factor, moving forward as to how we, how central banks, move their regulatory hands, if we shouldn't put that. All right. So moving forward, the resurgence of COVID-19 cases, hospitalization, excuse me, and the deaths in recent months is causing great hardship for millions of Americans and is weighing on the economic activity and job creation. Following a sharp rebound in economic activity last summer, momentum slowed substantially, with weakness concentrated in the sectors most adversely affected by the resurgence of the virus. So this is another important point. So the resurgence or the second wave, which was something that was in the air, okay, and scientists warned could happen, but I guess was ignored in some parts in some countries and was taken kind of moderately or with a pinch of salt. All right, and for different reasons. But when the second wave actually came along, it caused there to be, I wouldn't say the same kind of magnitude of a crash, but it did really recede, you know, the economic growth and, that restart is kind of like you shut down the computer again. You try to restart it the first time and it didn't do what you want, so you switch it off and try to switch it back on again. Has that effect? Okay, but the first time you waited an hour for it to reboot, second time is 15 minutes. Kind of same picture if you get what I mean. So the second wasn't as worse as the first, or wasn't as bad as the first, but it still did cause an issue economically speaking. Okay, now moving forward, okay, as it says here, the economic recovery remains uneven and far from complete, and the path ahead is highly uncertain. Okay, and usually central banks have 20, 30 years ahead projections, but in this case, because of the nature of what's happened, it's very difficult to see the future. The future is hazy for everyone, and so all of their 900 PhDs they have inside of the Federal Reserve have to really think outside of the box. Okay, literally sometimes. Okay, to understand where and how they can move forward to bring stability and harmony. Okay, because the Federal Reserve has a very high, the highest responsibility in the world as a central bank, because what they do affects not just their economy but the world economy, and so they have to make sure they take very, very stringent precautions as to how they do things. Okay, any mistake they make, even the slightest one, could mean massive consequences. So there are many things here. We can see that, as I'm skipping this area here, I'll come back to it. All right. As with the overall economic activity, the pace of improvement in the labor market has slowed down. And over the 3 months ending in January, okay, so the last quarter, Q4, all right, employment rose at an average monthly rate of only 29,000. Okay. And we can know this is still COVID related. We can see this is, COVID related. So skipping further down, okay, and I will come back to some certain points. I just want to highlight the main things for you. The pandemic has also left a significant imprint on inflation. Here we go. So here's the key now. So this is a nice way of saying that, okay, because of COVID-19, we've had to print more money, which means we've printed more debt and therefore more inflation going forward, following the large declines in the spring. Now, consumer prices partially rebounded over the rest of last year. However, for some of the sectors that had the most adversely affected or have been mostly affected by the pandemic, prices remain particularly soft, okay? But in some areas, prices have really risen for certain goods and services, okay? Now, overall, on a 12-month basis, inflation remains below our 2% long-run objective. Now, this is a line that every central bank says. They always try to keep inflation at 2%, all right? But we'll talk about inflation another time. But this is the key that they're trying to go for. If they're above 2%, then it's a problem. If they're below, then for some reason it's fine according to them. But that's for another day. Now, while we should not underestimate the challenges we currently face, developments point to an improved outlook for this year later, or for later this year. In particular, ongoing progress in the vaccination should help speed the return to normal activity. So I want to say this here. So when it comes to economic recovery at the moment, the speed of vaccination really is going to be the key that you want to be looking out for in the news to see how vaccination developments are taking place to combat COVID-19. Because until that beast is put to rest, or at least put at, in restraint, okay, economy can never return to normal. Now, what we're talking about here, discussing, about COVID-19, once everything has blown over and things kind of even out and life turns back to normal again, and we don't need masks, I mean, it will be a thing of the past, but the effects of COVID-19 are still going to be ongoing past that point. Because you have to remember, in every financial crash, okay, new money has to be created. In this case, we've had money go back into the population, which is something that hasn't happened for a very long time. And for that reason, you know, printing money is a short-term fix, okay, for a long-standing problem. And the long-standing problem is the fact that we're not on a gold standard system. Currency isn't backed by anything but nice words and economic figures and mathematical calculations, and I guess other lesser things, but nothing of real, true value. And therefore, for that reason, uh, you find that after everything has blown over, the real consequences of COVID-19 are really going to surface. But of course, they cannot say that right now because it will cause a frenzy. All right. But it's something that is, in the pot boiling. All right. And we'll do many more videos discussing that. And, personally, what I think too. So switching to monetary policy now. Now, turning to monetary policy, in the second half of last year, so 2020, the Federal Reserve Open Market Committee, or FOMC, as we call it, completed our first ever public review of our monetary policy strategy, tools, and communication practice. Now, this is the first ever public one, which is very important, something very different that they haven't done. And I happened to watch this, it was very interesting. Okay. Now, I'll find the link and put it in the description for you guys also. We undertook the review because the US economy had changed in ways that matter for monetary policy. Okay, the review's purpose was to identify improvements to our policy framework that could enhance our ability to achieve our maximum employment and price stability objectives. Okay, so maximum employment, best price stability is what they aim to do. Okay, which is understandable. All right. Now, skipping forward, let's talk about the implementation. So we now in their framework, what they've implemented now, their 2% goal is what they talk about all the time. All right. And inflation, there's many things that can be said about that, but I'm fighting myself not to talk about it and because of time too. But anyway, back to what we have. So we've implemented our new framework by forcefully deploying our policy tools, forcefully. All right. Note the word forcefully, which means under an emergency. So their policy tools now, let's just be straight here on this point. Whenever a central bank says that they're implementing policy tools, the only things that they can really do is to buy government bonds, print out more money, manipulate interest rates and other different types of rates to bring stability, to get to that 2% inflation target that they're going for. That's really what they do. So when it sounds very complicated, it is actually complicated, but in essence, that's what they're trying to do. So as noted in our January policy statement, we expect that it will be appropriate to maintain the current accommodative target range of the Federal Reserve funds rate until labor market conditions have reached levels consistent with the committee's assessments of a maximum employment and inflation has risen to 2%. Okay. And it's on track to moderately exceed 2% for some time. Okay. No worries. In addition, we will continue to increase our holdings of treasury securities. Okay, now again, so when they're saying they'll continue to increase their holdings of treasury securities, all right, it's a very nice way of saying that because of the current situation now. If you've watched my uh, podcast, if you haven't, go and check that out. Okay, is called The Wealthy Show. Okay, on YouTube, you can search us out. Make sure you give us a follow and some likes. But if you check out that video that I've put called The Triangle of Death, it goes into deeper detail about this situation. Now, in other words, what's happened in a situation where there's a financial crisis, okay, when the bond auction goes off, and the bond auction, what happens is that the government is selling its debt to the public. So countries from around the world buy these government debts, at a certain interest rate, and the aim is to get a return on the investment, and is also kind of supposedly supposed to be a very secure, what we'll call a AAA investment that is very highly unlikely to default. Okay, which has been fine for for many, many, many years, and should continue that way for quite a while. But when you hear this term, nicely written, that they're looking to, you know, take up some of those securities. In other words, what the Federal Reserve have done is that they've printed out money, which has created debt, and given it to the US government for what they need to do. And the US government has then turned, that debt into what we call T-bills or treasury notes, okay, and which is government bonds, and they auction that off. Now, after they've auctioned off that those T-bills, okay, when the bond auction comes along, if people don't buy those bonds or there's not enough purchasing of those bonds, then the Federal Reserve steps in to purchase some of those bonds to keep an equilibrium to make sure that the bond yield price or the bond yield price and inflation kind of balance out in a healthy way for the US economy, in the simplest way I can put it. So this is what they're trying to say. And agency mortgage-backed securities also, all right? Same kind of situation there. So these purchases and the associated increase in the Federal Reserve's balance sheet have materially eased financial conditions. Okay, so in other words, what they've done is that they've eased the condition because in government bonds at the moment, because of this situation, and I'll say it with my chest, as we like to say, but government bonds are a Ponzi scheme. Okay, and if you haven't watched the video again, please watch the video titled The Triangle of Death, and you understand exactly what I mean. For my students, you know exactly what I mean when I say this. But aside from that, when we look at what we have going forward, okay, we have this purchasing taking place is just to be able to keep an equilibrium so that the the yield rates don't go crazy, and inflation can, balance between inflation and the yield rates stay in the equilibrium that they have in place. Sometimes the bond rates are above inflation, and sometimes inflation is above the bond rate. So if inflation is above the bond rate yield, nominally people will earn more money. So if you have $1 million and it's 2% or 2.718%, or just let's call it 2% anyway, it's usually roughly around 1.718% and etc. But let's say it's 2%. The $1 million you have, you will gain 20K on that. But then if inflation is higher, then your buying power goes down. So you receive more money nominally, but you still lose out on money in terms of buying power, which is the true value of the currency. Okay. So this is important. If it's the other way around and inflation is lower than the bond yield, then you do make something. So this is what the situation is. So to keep that equilibrium, this is what the Federal Reserve does. And this is the tools that they actually have. There's nothing else they can do unless they change the system. All right. So ending this off now, before we go to the technical side, since the onset of the pandemic, the Federal Reserve have taken actions to support more directly the flow of credit in the economy, so quantitative easing, stimulus, deploying our emergency lending powers to an unprecedented extent. Now, this unprecedented extent, don't take that term lightly. As I've just described between the 2008 to 2020, as I said, some people think it's the same, but it's completely different. Okay. And they've enabled, a large part of financial backing and support from Congress and the Treasury. Okay, so this is where fiscal policy and the central bank become one. All right. Although the CARES Act, okay, so Coronavirus Aid, Relief and Economic Security Act facilities are no longer open to new activity, our facilities remain in place. Okay, so this is a key. The CARES Act is facilities are no longer open. Okay, I think they've kind of maxed out on how much they can do or to their targets, seemingly. And so the rest now, the other facilities they have in place to help are still open. Now, we understand that our actions affect households, businesses, communities, and across the country. Everything we do is to the service of public mission, according to them anyway. And we're committed to using our full range of tools, okay, to support the economy and to ensure that the recovery for this difficult period is as robust as possible. All right. And so this is the end of the statement. Okay. So really well written, actually. But as we can see here from the key points, just recapping, that is very clear looking at these paragraphs. And I have skipped over a few, but the main things you can see here, okay, stuff that I'd say are the important to look at because of the COVID situation. Some of the main things is that, for example, here, the economic recovery remains uneven. So this phrase right here is highly important so you to know that most likely the interest rates will stay the same. Okay. They're very, monotone about this. There's no, change really that's going to happen for a while. I don't think we'll see anything for the next quarter or two for sure. Okay. And you can see from these terminologies here, and then coupled with what we have going along down here, with implementation of new framework and etc., it seems as though we're still in a stage of recovery for quite a while, in short. Okay, now when we look at this, it's very clear to see that most likely the interest rates won't change the same. And so the consensus or whisper number is most likely going to stay the same. If ever this statement changes and we have a new picture going forward, we'll know what to do. But what's important to keep our eyes on, of course, will be the COVID-19 recovery. Now, for different currencies that are paired to the US dollar, they also have, apart from the overarching COVID-19 situation, some other currencies have their own other fundamentals, like, for example, the UK with Brexit and post-Brexit situations. The New Zealand dollar, Australian dollar, those economies, they have other fundamental factors that are hugely important to themselves and to the world in some places, or nationally, or to the local economies near them. Like with the UK, me being from the UK is easier to talk about. Brexit does affect Europe massively, which is important. So just to finish this off, all right, let's have a look at Nzd USD. So I'm going to look at this from two sides. Let's switch over. So first, I'm going to do it the other way around. I'm going to look at Nzd USD intraday. Okay. Now I have the US dollar here as a third tool. And what we want to look at is the pair correlation. So if I look at the pair strength correlation, or just looking at the correlation of these two pairs. So if I look at NZD now, as I said earlier on, if you have two pieces of high impact news or a range of high impact news on both sides of a currency, it's very good to watch that currency sometimes because there's great opportunity that can be there, because it's very clear there'll be high volatility there. And if you know what you're doing, you can grab a fantastic opportunity. So if you look at XAU NZD, all right, I'm going to hide the Canadian dollar because we're not looking at that at the moment. So let me click hide. So if we look at this now, both of these currencies intraday are in the minus, which means gold has gained strength against these two currencies. All right. Now with the US dollar, gold has gained strength against the US dollar at minus 10.97%, whereas with the New Zealand dollar, gold has gained strength 15% or minus 15% change. In other words, from what we see here, the US dollar is stronger than the New Zealand dollar. And if that is the case, okay, then we should see a bearish New Zealand dollar intraday. Now, this gap is seeming to widen out as time has gone on, okay, for the meantime. So starting from the beginning of this year, moving down to where we have in the final part of this third quarter, we can see that we have a larger separation here in what we see with the strengths. Okay, now this may change. Okay, if we look at another time frame, if we look at the monthly, okay, on a monthly time frame, same thing. Okay, we can see here that the US dollar seems to be a lot stronger than the New Zealand dollar, but this can easily change. Okay, but this is what we're seeing. Even if I zoom in, okay, all right. So if I zoom in here a little bit more, all right, we can see in a bit more detail that we've had these interchanges where the New Zealand dollar was stronger at one point and then kind of dropped in its strength. And now we're kind of round about here. So when you zoom in a bit better, you can get a better view. So roughly we have the New Zealand dollar at 30% and 38% for the US dollar. So we haven't got that much of a gap, an 8% gap, and this can easily change. We can see that since 2018, there's been a real battle between the two currencies, you know, competing. There's times where the New Zealand dollar is stronger than the US dollar comes back. This kind of bounce between the two. So I expect it to continue, and I'm interested to see where it's going to go. So before the news comes out, let's just have a look to see what's going on. So I'm going to switch over my charts. Let's look at MetaTrader and see what we can grab on there, if there's any opportunity. All right. So opening up what we have going along here. So I'm going to quickly pull up the New Zealand dollar. All right. Nzd USD. Where are you? So let's open up a fresh chart. Quick analysis under a minute. All right. So with this New Zealand dollar news that we have here, so I'm going to take it from the higher time frame and look at what we have now. For me, looking at this on the higher time frame, I would say that the bias is still heavily bullish. Okay, if you look at market structure swings, we have an A swing, we have the B, and we have the C swing here. So when the financial crash happened, we had a nice drop back down into a demand order block here. So we had a very nice drop into demand over here. Moving forward, you need the wicks to be able to capture this one. And so we've seen that in this new movement, we've had an A to B swing here. We have a double top formation. So this is a lovely liquidity pool, which means that there's a lot of orders above here that sooner or later the market will go for. Okay. And this liquidity double top situation here is a common retail trader pattern that retail traders trade. And so there would be a lot of liquidity above these highs right here. Okay. A lot of significant price points and levels and round numbers and things like that. So if we look at the next swing from A to B, you can see how the coronavirus period scarily fits into this structure of price for another swing from A to B. So if I grab this, look at our Fibonacci levels. Okay. So looking at Fibonacci, all right, price dropped to the 86 level, almost to about it. All right, we had this nice, beautiful flip zone order block here. It's flip zone order block here. The price spiked into it perfectly and gave us a long. Okay, and now we can see we have a very strong bullish run all the way back down from, almost just above, 50 cents for one New Zealand dollar back to 71 cents. So a very strong recovery since 2020, since I'd say March, around April. And I do expect this to continue in this movement. However, if I look down to the lower time frames, we've had this high of 2018 taken, and there's still some more highs. So I expect the bulls to still score some points and take some more highs here. So these equal highs. So this liquidity, long-standing one, liquidity pool from 2018 has been run. Okay, and I expect more to happen. Now the news has just come out. All right, but I don't expect much to happen at the moment for now. Okay, I know that the volatility will increase momentarily, but I'm not too convinced that there's much going to happen with the news. We may get some movement, but nothing major. All right, so going to the D1, all right, intraday, price is still heavily bullish and clearly bullish, and I believe it will continue. Okay, what I would hope to see possibly is some short action here, maybe. I see this low here from the previous month that hasn't been taken. Seems like there's a lot of activity at this price point here. Going forward. And a lot of activity going along here. All right. And the price came back again for these near to these lows, but didn't run the lows. So I would expect the price to kind of give us maybe a short in some degree to reload to go long again into this bullish bias. And if it wants to drop lower than that, we'll see. But if I just draw the body of this candle, the price hasn't returned back into demand. It's returning to the demand from here. But I would like to see this low get run and then the price to possibly push long. Now, what do we have going forward? I'll delete this for a minute. So we can see, okay, the news has had a reaction. We have quite a bit of a long going forward. All right. We've had a nice bullish run long, but this is not really the concern now. For those of you who are my students, you saw the analysis that we talked about earlier. Now, the price action we had here was perfect. What the market did here was to create this triangle over here. And this triangle is a retail trader pattern that most traders will be looking to sell from. And I said to you guys that most likely, and if you saw my other markings, I think I have it here. You can see my markings right here. I was saying that there's two options. So if I switch over, this triangle created, I said that most likely the price has broken below, but it's going to stop hunt, come for the highs above here, and manipulate traders who trade these patterns to believe that the price is going to go short and then completely swing the other way. And as you can see, the price has done just that. I think it still has a bit more to go. It needs to go for these highs and it will continue to move forward for the long here. But you can see what we've had here. Very interesting move. So this is why we don't trade patterns. We trade and understand how the algorithm of the market works, because it's a lot more important. And you can see, just as I've said this afternoon, for those of you in the live analysis session, this is what we've had. Price was broken above here. And I expect it to continue to go short. However, to mess around with this triangle will be the perfect picture, because we've had a 5-day story being created. So I would say 7 days actually. Okay, minus the weekend, it is 5 days. But from the 9th of March or 10th of March all the way on to the 17th today, the price has been creating this scenario, of a bearish, price action pattern, which is a perfect picture to get traders to want to buy and sell, because you can see that, the ranges have worked out very well. When the price broke this range, many traders probably had sell orders because we had a break beneath, and this spike here was a return. So there must have been a huge amount of sell orders from retail traders. And as you can see, the market smartly has taken this high now, and you can see that is reversing, and basically tricked many sell traders into the sell and stopped them completely out. And now, with all of those stop losses in place, the market has made a profit, and now the price should be reversing for the short very soon. Okay, so we can see here that I believe that the US dollar being stronger than the New Zealand dollar intraday, we should get the short. And I believe that now that we've had this 945, possibly could be the catalyst to actually go short. And this is why I said this afternoon, timestamp. So you can see this spike here, how wicked this spike is and what the price has done. A massive, massive stop punt here. And you can see the price has just come back to the other side and is now selling off very heavily. All right. So I hope you guys enjoyed this short analysis. It wasn't too much of a deep analysis. All right. And I hope you guys enjoy and take care.